Up to this point, we've been talking about a single type of product that a firm has. Now, quite often, they will have more than one product. So we want to take into consideration what is the break-even point across the firm when they have multiple products. There are certain steps we go through to do this. We determine the number of units we're projecting to sell of each product. Then we calculate the contribution margin for each product. Then we calculate the weighted contribution margin. We calculate the break-even in total units, and then we allocate those units back to the individual products based on their percentage of sales in units. Now, you probably need to be looking at lecture handout 13-1 as we go forward in this next calculation. First, how do we calculate the weighted contribution margin? Well, you take the unit contribution margin times the number of units for product A, plus the unit contribution margin times the number of units for product B, C, D, E, and F, and so forth. And then you multiply those out, total them up, and divide them by the total number of units to get the weighted contribution margin. So here is an example. We have 3 types of meals we're serving: early risers, children's, and ham and eggs. And so in total, we have 200,000 meals. They have different contribution margins: $3, $2, and $1. So we have to take the $3 times the 20,000 meals, plus the $2 times the 100,000 meals, plus the $1 times 80,000 meals, divided by the 200,000 meals. So when you multiply those dollars out in the numerator and add them together, you get $340,000 divided by 200,000 units, or $1.70. Now, to do a rationality test on this, the weighted contribution margin should be higher than the lowest contribution margin for a unit, and lower than the highest contribution margin, and be centered pretty much where you have a concentration of the same type of contribution per unit. So when we look at the $1.70, it's higher than $1, it's lower than $3, and it's focusing very close into that $2 area that we find in the second product. So we have fixed costs of $255,000. So to get the break even in units, we take the weighted contribution margin and divide it into the fixed costs, and we find that the break even is 150,000 units across all products. Now, the next thing we need to do is to figure out what's the break even going to be projected for each one of those products. So we allocate them based on the percentage of the number of meals. 10% of our meals were early risers, 50% were ham and eggs, and 40% were children's plates. So we take and head up each column with the $50,000 of break-even units. 10% of those are going to be allocated to early riser, 50% to ham and eggs, and 40% to the child's plate. So we now find that 15,000 is the break-even level for early riser, 75,000 for ham and eggs, and 60,000 for the children's plate, or a total of 150,000 units. Then we can proof that back if we want by multiplying the break-even units by each type of meal by its contribution margin. So 3 times 150,000 is 45,000. $2 times 75,000 is 150,000. And 1 times 60,000 is 60,000, or a total of $255,000, which is our fixed cost. Now you can also calculate the break-even in sales by dividing the projected break-even fixed cost by the contribution margin to get the sales. And if you did this, for example, the early riser breaks even at $105,017 in sales. So now you can see that the break-even not only applies to a single type of product, such as a trucking company with miles or airlines with airline miles and so forth, but with companies that have multiple products. Now, is it going to be exactly the same at the end of the year? No, it's not. Maybe early riser will end up with 18,000 meals and ham and eggs will end up with 60,000, or Chow's will end up with 70,000 meals. But this is a planning device. It's better than doing nothing. It gives you something to monitor the progress against during the year in order to keep yourself in a profitable position.